Hello, investors. Welcome to the channel where I use technical analysis to find possible swing trades. Today, we're taking a look at J.M. Smucker Company, ticker symbol SJM. It's a mid-cap company with a market cap just below $13 billion. It is perhaps best known for its jellies and peanut butters and jams. But as I look through this company's summary, I admit I'm impressed with the number of products that it sells and creates here. I was surprised to find out that they have a significant pet food segment and a coffee segment. I'll just read off some of these brands because I did not know that Smucker's owned all of these brands. For instance, Meow Mix, Milk-Bone, Pepperoni, Folgers, Dunkin', of all things, Jif, of course, Smucker's, and numerous others. And I'll also point out that this company was founded in 1897. So it has been around for 126 years, which is an impressive period of time. And here we are on Smucker's annual chart, and you'll see that it is well below all the major moving averages, and it looks to be bottoming. Of course, that is not 100% by any stretch, but more importantly, you'll see there's this huge gap down as the company's target price was revised down by several rating agencies. And although you have an earnings beat here, they gave poor guidance, particularly because of increased cost of manufacturing. And they projected that their total profits would reduce by about 10% over the next year. And if you look right about here down to about here, where it is now, it's about a 10% decrease. Of course, on the flip side, if the share price rises back and fills this gap, and we know about 90% of gaps do fill eventually, then that would signify about a 10% increase in share price for those who bought in after this gap down. And if we look here on the RSI, you'll see it is oversold and is turning up again. Both stochastics are oversold and are rising. And if we look at the volume chart, you can see there is a huge spike in selling pressure, which is decreasing and has finally been replaced by buying pressure. Although I wouldn't consider that canon by any stretch. It could certainly switch back to selling pressure and go lower. And the MACD looks to have formed a trough and is rising. And here on the fundamentals page, I'll note one thing here, the difference in data between E-Trade and Schwab. Here on Schwab, you'll see that this shows an earnings beat. However, if we look over here on E-Trade, it shows that it was not profitable in the last quarter, which accounts for the large drop in share price. In any case, here we have less than 5% short interest. It's still a decent amount of short interest for a company of this history. Something that's been around this long and has such a significant number of products in the market, this many staple foods, at least here in the US, this is more short interest than I would expect for something that appears to be this stable. The institutional ownership is just shy of 80%, which is solid. The debt to equity ratio shows average debt for the industry. Fair enough. PE ratio does not apply, doesn't give a PE because, as I said, E-Trade shows that it is not profitable. Now, the gross margin of 34.38% is actually well above average and beats out 83% of other companies in the industry. And even the operating margin of just 3.24% shows that it beats out 64% of its peers. So it's still above average, but you see this net profit margin is negative 0.21%. And that is where all the negative data is coming from here. And of course, return on equity is negative because the profit margin is negative. Growth rate also similarly negative. Now, the dividend is excellent at 3.34%, but because the company was not profitable, according to the data here, then it is not showing a payout ratio. That would be more than 100%. In any case, I do think Smucker's is a good company. It's likely just fallen on the difficulties that most companies, particularly retail companies, are facing now with increased cost of production and shipping, all the normal things that we've seen in the post-COVID world. But I do think that if you can get it for the right price, this is an excellent long-term buy and hold. In fact, if we switch back here to the 5-year chart, you'll see that we are down here to where it was just about before COVID, before the crowd, way back here in 2019. So current share price is fair, although after looking through some of these share prices, I went back to the 10-year chart. I think if you can get this below $110 a share, that would be great. And if you get it below $100 a share, that's the back up the truck moment. But I will leave that up to you. And certainly, please let me know what you think in the comments below. And remember, none of this is financial advice. I'm not a financial advisor. I offer these videos for education, information, and discussion. And if you got something out of the video, I would appreciate it if you'd hit the like button and subscribe to help out the channel. If you enjoy this kind of content, please hit the bell notification to be alerted when new videos post. Also, if you'd like me to take a look at a particular company using the indicators I present here, just mention that in the comments and I'll try to get to it as soon as I can. That's all for today. Thanks for watching and good luck with all your investments.